Good afternoon, everyone. Thanks for joining. We'll get started in just a moment. Good afternoon. Thanks for joining us today. If you'd like to ask questions during the webcast, please type it in the Q&A you'll find at the bottom of your screen in the meeting control bar. I'll now turn today's webcast over to our host, Dean Demchek. Gene Demchek, Marsh's Global Education Practice Leader.
Thank you, Adam, and welcome everyone to our 14th annual market update for the education industry. I lead Marsh's education practice, and we're thrilled to have you here today. We have about 142 participants, and we wanted you to know that the questions you submitted ahead of time are already included in our content. So we look forward to addressing those. If we don't get to all of them, we'll be happy to respond afterward. So let me introduce our panel. Paul Shervine is joining us. You may know many of these panelists from prior years, but Paul is part of our market information group. I call him the Obi-Wan Kenobi of everything to do with markets, insurer, solvency, et cetera. So we're thankful to have him today. Marty Light joining us today to talk about what's happening in cyber. Mark Turkolo, as you know, is our leader for education and public entity placement in the US. And Dave Letzelder, who is part of our US property practice and a key member of our higher ed property work that we do. Ken Simic joining us from Mercer to talk about health and benefits, and Jeff Smith joining us from Mercer as well to talk about student health. So we wanted you to know that the session is being recorded and the replay with the presentation materials will all be shared with the participants. So that gives you an opportunity to sit back and enjoy, hopefully, our content that we're sharing today. So if we look at the agenda, during the 14 years that we've been providing this update to you, we have seen a lot of market cycles. Possibly more ups and downs, depending on your perspectives. But in 2020, we see promises of more changes and many new twists that are coming our way. So as you can see, we are covering every part of what you might need from across the spectrum. We hope this information will be helpful to you today, and we look forward to beginning just now. Paul, I'll turn the discussion over to you.
Thanks, Gene. After 14 years, I just realized I'm looking like the Alex Guinness Obi-Wan Kenobi instead of Ewan McGregor from the previews, so it's starting to fit right in. But anyway, what I'd like to do is discuss what results were in the U.S. We just got them last week. And next slide, please. You know, despite, you would have expected probably a prettier high combined on this, but, to still come in under 100% is pretty amazing. What we were probably thinking about at the end of March and the expectation, what are COVID losses going to be like, what's going to happen with a bunch of different lines of business as far as utilization. But even with this, you still see about a 2% increase in net premiums. Now there's a lot of offsets on this. You got more premium on casualty property side, D&O obviously, for workers' comp and commercial and personal auto fell, obviously due to a lack of drivers on miles and what they were seeing as far as workloads for that. So it kind of muted each other, but still it's a pretty good, showing how resilient the industry was. Now, even with this, you did have a 50% drop in underwriting gains, but still you've got an underwriting profit, which is, once again, I said, it's pretty showing the resiliency of the marketplace and what they've been doing the last 4 years. I know in certain lines of business and in certain industries, we've seen approximately 11 or 12 quarters of rate increases, depending on what lines they were writing. So, there's been offsets on both sides, which kind of keeps everything, kind of status quo for the year, which is good for the industry. again, you had a nice rise in surplus, 22,898,000,000. I do know we were concerned during the first half of the year what the effect was going to be on results, and also with cats in the third and fourth quarter. But still, the industry even though a lowering investment income, still a pretty good boost to the equity position in the industry. And the United States on its own is a significantly well capitalized industry right now. Uh, yeah, you had an unrealized capital loss improved lately from a larger loss in June 20. So while it is loss, it was significantly higher. And the reason behind that were Berkshire Hathaway and State Farm. At least Berkshire had a higher equity portfolio, so they took a bigger loss. It's probably down by about half from what it was, but State Farm and Berkshire were leading that. And both of those had turnarounds in the second half. And once again, as you see, $49 billion in net income, down $13 billion from a prior year, but still a good number considering what was going on in the industry. As I said, cats added a lot of points this year. Depending on what metrics you're using, best peg these at about $60 billion, which I'll go into later, but still, it's a big number to handle with the capacity base that they have. And it's been expected that net investment income is going to fall as it did because of lower interest rates, zero on some types of instruments. And the PC industry keeps a lot of their money on the bond side. They don't get the upside that you're going to get from the stock market rise that you may see on life, health, or other industries. And they still had, again, favorable loss reserve development, but in 2020, but we're looking at this to decline as, best is estimated, depending on what line of business, between a $7 and $12 billion deficiency before discounts. And if you add in, workers' comp discounts, that could go up to 29 billion, excuse me. Next slide, please. Yeah, as I said before, the best has said it's a very strong industry capital basis. They came out with a study today on that, highlighting the fact that, the trends in the United States as far as capital is, it's still a very strong situation, to the point that, rating agencies changes have been almost non-existent based on COVID, and even with cats. Now, we have seen some action in the South due to Louisiana losses and Florida losses on homeowners, but those are mostly very smaller players in the personal lines. Dividends to policyholders, due to the fact that there was a drop in mileage driven, they had to give back money through refunds, or they gave dividends to the client. So that added like 3 or 4 points depending on the company writing it, and that was taken into considered. So if you take that out of the combined ratio, it does even better. I mean, what they've been doing, as I said before, is there's been a number of lines of business that have been creeping up on rates quarter to quarter. And I think that action is what Beth said is, has kept the declining premium volume and COVID losses from really hurting the industry. So they have a pretty strong base to go forward. And as I said, $66 billion in cat losses. 11 billion alone was wildfires. Then you had different cats, and also the convection losses were very hard. Convective storm losses, as you can say, were 30 billion more than hurricane losses. And I can't actually tell you the last time I've ever seen that in my life. I don't believe we've had convective losses, storms, the Midwest, what we saw, which was massive. And that was something that we've never seen before as far as an industry. So that's something to bear, watching going forward, depending on climate change and how this affects different areas. And it's also going to affect going forward how insurance companies are going to deal with these different regions that they didn't expect it. So there's going to be changes there on the primary side and also on the reinsurance side. As we said, wildfires are an issue, 11 billion in losses. A lot of that obviously was California. That's continuing to plague the utility industry out there. And you don't see a major chance of that abating until they're able to deal with, power lines that they have and how they can start fires. And just, we've seen it on TV that you can just wipe out an entire neighborhood or a town just by these fire losses occurring. Next slide, please. So we're seeing so far, this is a global number. It's $37 billion that companies have reported directly related to COVID losses. This isn't investment income or investment losses, but just what they're booking so far. And as you can see from most of the companies here, like Munich Re 4.1, Lloyd's 4, Swiss Re, oxytalanx. A lot of these are reinsurance losses. Reinsurers do pick up a bulk of major catastrophe losses like this. That's why the recent renewals for the reinsurance market had companies taking different tacks on how they're going to deal with this. And while the rates weren't as high as expected, it was a pretty good hit. So we have seen on the retail side companies pulling back on the limits they're offering. We've also seen companies such as AIG just reduce limits they're offering across the board and by lines of business. Chubb has a lot of personal on this, so they could get hit with that. I mean, their first number was 100 million in the first quarter, and they jacked it up to 1.2 billion within a quarter because they needed to get a feel for it. The question around these losses, even though it's 37 billion, has been and will continue to be business interruption losses. In the United States, the insurers have been prevailing for the most part on coverage issues, whereas in Europe and the UK, continental Europe and the UK, there have been court judgments saying they have to cover some of this, but it hasn't been as bad as some people thought. There have been a couple of companies in the UK, such as Hiscox and Beazley, where they thought this would be massive. They're only posting about 48 to 50 billion pounds or euros in losses. And Berkshire Hathaway, another one, a reinsurer on the back end through National Indemnity. It's still a low loss for them on this. Next slide, please. Now, this is obviously it's a big number. As I said before, we saw it in the United States. We're seeing it globally. Again, this is going to be pushed by, as you can see, a lot of reinsurers. Swiss Re and Munich Re with big ones, Lloyd at 4. So if you put these two numbers together, you got Lloyd's at 8 and the other ones at about 10 billion each, just for catastrophe and COVID. Chubb is now at like 5 billion. Allstate personal lines was going to get hard in catastrophes. AIG the same, because they got a personal net worth group that does a lot of personal lines insurance, as does Chubb. Allianz is more global, so they're going to get hit in Talanx as a reinsurer, along other lines. They also have a primary group. They also have Hanover Ruck, which is a pretty big reinsurer. So that's why you're going to see these large losses. But again, when you add these up, you can see that most of the losses are either going to very large carriers or large reinsurers. Most of the retail companies that don't have a lot of this and ceded off a lot of business were not nearly as hit hard as others. Next slide, please. Now, looking at United Educators 2020 results, I'm sure Mark's going to go into further detail on what actually caused all these losses, or the combined ratio going up to 107. But I frankly can't remember a year where United Educators combined ratio is above 100. They still managed to increase business on gross premiums. Rating is still good. Adjusted net income, considering loss, combined ratio being approximately 8 points above the industry average. Surplus is still robust at $375 billion. You get an asset base on, I'm going back a few years, a lot smaller company 20 some years ago. It's got an asset base of $1 billion, which is positive for policyholders. And the ability to make money when you have a bad year is very important when you have limited access to outside capital. They've also maintained their retention rate at about 98 to 99%. And as I said before, they're maintaining their current rating at a rating from AM Best. So all in all, considering a tough year and what I'm sure they look at, tough roads to hoe going forward, it's a strong balance sheet. It's a smaller company, but it's still got a significant surplus base for the amount of premium it writes. I mean, its leverage measures are very low. The industry as a whole writes at about 60% net premiums to surplus, and United Educators on a gross premium is at that same number. So we've got a low leverage with a high asset base, a nice size surplus base for what they write and the amount of business they have, and a conservative investment profile. So I think all in all, through 2020, they've done a good job. I know we got one question in about capital in the marketplace. I'd like to address now that what we've seen is, right after we had these COVID losses and there were shutdowns, some of the stronger carriers, seeing a low interest rate environment, went to the market to raise funds because they're getting significant debt at 2 to 3%. Jump on or trade, going out at 4% now, which is kind of ludicrous when you think about it, when back in the day they were 12 to 14%. So we had a lot of debt issuances. Fairfax, Chubb did one. We've also had a number of other carriers realize they've taken losses like QBE, and they went to market. Some of the UK carriers, of Beasley or Hiscox, also went to market to raise funds. But an interesting thing, we've had these new players come in that are, for example, Catlin, who is at XL Catlin, set up his own company to write on a basis. You have Convicts, and they're coming in with about $1 billion each. But the interesting point on the back end is there's a lot of money going into MGAs that, for example, a gentleman who was CFO of our firm a number of years ago, Mitch Blazer, set up an MGA and is utilizing Lloyd's paper to write. So I think we're seeing different avenues come up where it's easier to set up an MGA and then, access capital elsewhere, or also fund the Lloyd's syndicate or some other vehicle, or if they're doing line slips. So it'll be interesting to see what goes on in 2021 if we continue to see additional capital in. The last point on that was the alternative hedge vehicles, and there was a complete dry out of the alternative vehicles coming in on reinsurance and on some debt issuances really slowed down in the first half, but has jumped back. We're starting to see a lot more, and in conversations with Guy Carpenter, how it kind of dried up in the first half and has picked up now in the second and going into 2021. So I think people are still looking at all opportunities. There are a number of retired executives who are setting up other companies and looking when they can start. So it'll be interesting to see what that happens in 2021. And with that, I'll turn it over to Marty for cyber.
Thanks, Paul. Appreciate everybody's time today and having me on to lead this discussion. If you could just go to the next slide. So I think it's no secret, anybody who has dealt with a cyber renewal over the first few months of this year or towards the end of last year, that the marketplace has become quite turbulent and volatile for cyber insurance. And before I get into the specifics around what we're actually seeing, I think it's always good to have context on what is actually driving the issues that we're dealing with on a day-to-day basis. And it's funny, I used to tell folks that I don't go a day without talking to a client about ransomware. Unfortunately, it seems like I don't go more than 2 or 3 hours with talking to a client about ransomware. It's by far and away the number one issue that we've been dealing with over the past year and a half or so. And I think most folks understand what ransomware actually is, but a couple of data points that really signal the specific challenge that ransomware causes today compared to where we were, let's say, a year or a year and a half ago. Average downtime is now up 31% compared to Q1 of 2020. And that average downtime is exactly 21 days. So if you have a ransomware event, on average, you're going to have technology downtime of roughly 21 days. And that can be quite significant. The other variable here is data exfiltration is up 218%, right? And 70% of attacks now include some type of threat of data exfiltration. So the notion that you can simply pay the ransom demand and the claim will go away is no longer really the case. The consequences associated with these events are becoming more and more challenging and more significant. And while I oftentimes say there are a menu of different issues that are impacting the cyber insurance market, the one that has a direct correlation to loss ratios and combined ratios, I would say, is ransomware. Some other issues that we're seeing and we're monitoring, certainly COVID-19 and the virtual learning environment from a higher education standpoint. And I would say even beyond higher education, the broader notion that COVID-19 has created greater dependency on technology than ever before. And while it's definitely allowed many different institutions and organizations to recognize efficiencies through technology, it's created more inherent risk, right? If technology doesn't work for a certain period of time, historically, that might have been less of an issue than it is today. The other thing I would throw out there is targeted attacks on research information. I've been speaking about this one for many years, and with most of our clients, this has been a very theoretical type of issue that we've always been concerned about, but haven't necessarily seen play out in practice. Through 2020, that wasn't necessarily the case. We did see ransomware situations where research information, proprietary information was specifically targeted in those ransomware attacks. And if you have that element or component of data exfiltration, it can be very, very challenging, right? Other issues that we're watching, the regulatory environment continues to get more and more robust. We expect that to pick up steam throughout the rest of this year. Silent cyber and potential overlap around the property and casualty coverages and how they do and don't address cyber continues to be a very, very hot topic. Contractual risk, and then lastly, systemic risk. And this has really, really picked up steam over the past 2 or 3 months. When you look at some of the recent situations, one of them just happening just last weekend, where you might have one firm that has a potential incident or a potential issue, and that can impact a very, very large portion of the entire U.S. economy, or several, or a variety of different organizations that are using those technology platforms. So that's definitely something that we continue to monitor very, very closely. If you go to the next slide. So what does that actually mean from an insurance perspective, and how is the market responding? And actually, if you can go one more slide, I'm going to jump around a little bit. I'll go to the next slide, then come back. If you look, just starting on rates, right? If you look through 2020 and just focus on the first 3 quarters, rates were going up, but it was a relatively modest single-digit rate push that we saw from the marketplace. Most renewals renewing somewhere in that 5 to 10% range. And in fact, I would say in many situations, cyber was much less turbulent through the first 3 quarters than other product lines. That really started to change around October 1st. And it was just, again, with the continued uptick in ransomware attacks, the market really started to shift its position. And we ended the 4th quarter with average increases right under 20%. And as you can see through January, we're now looking at average rate increases closer to 40%. Most insurers are pushing rate anywhere from 30 to 50%. So it's been a very, very dramatic shift. If you go back to the last slide, you'll see we touch on that a little bit more. But from our perspective, the greater concern, obviously nobody likes to see rates going up at this type of level, but the greater concern that we have today is the potential scrutiny from the insurers around coverage. So starting on January 1st of this year, many insurers instituted strategies to control their portfolio's exposure to ransomware. And depending on the insurer you're working with, that can come in a variety of different shapes and sizes. So some insurers have instituted ransomware co-insurance into their programs. Some insurers have decided to supplement ransomware. And other insurers, with the concern around systemic risk, have looked to put restrictions around dependent or contingent business interruption. So those have been the focus points on coverage from the overall marketplace. The good news is there's still an avenue in many circumstances to get full limits for these coverages, but it's going to be highly dependent on the organization's security posture and their overall maturity of their security program. So underwriting scrutiny in this environment has significantly picked up. We're working really, really hard with our clients to come up with the most efficient process possible. Many most of our clients recognize that there's going to be a need for more information as we go through this more challenging marketplace. But many insurers are coming out with their own supplementals and their own questionnaires. So trying to compile those as much as we possibly can and utilize one source application to address many of the different issues that you're going to see across the insurance market is something that we've been really prioritizing as we go through this change. The other thing I would say on coverage that usually gets overlooked, and I think it's also a really important variable, is that many of these ransomware restrictions are not limited to just the cyber extortion section of the policy. So I think it's very easy to think of ransomware and you're really focused on, okay, the extortion demand, right? And it's one thing to have the extortion demand sublimated in these policies. It's another thing to sublimate all coverage parts around a ransomware event. And many of these policies or many of these restrictions from certain carriers are doing that. So it's very, very important to look very specifically at the language and make sure that if you are dealing with potential restrictions, that you clearly can understand them and that it's articulated as to what that's actually doing. If you go back to the next slide. The last thing I'll say, we touched on a lot of this on the prior slide, but what we have seen is certain insurers restricting capacity. So in some cases for higher education, insurers who were previously willing to offer 10 million are only offering 5 million. It's not an across the board type of position from the marketplace, but it is something that we are closely watching. The good news is we still feel that the overall capacity for cyber insurance and the capital in the marketplace is very, very strong, right? So a couple of years ago, I used to tell clients that the theoretical capacity for cyber insurance, which is essentially if every insurer everywhere in the world offered you as much capacity as they possibly could, that would add up to a number of about 1.8 billion. Today, we estimate that number to be at approximately 1.6. So it's contracted a little bit, but it's still relatively healthy. Insurers still want to write this business. They're just trying to figure out the best way to do it profitably. Next slide. So diving a little bit deeper into the macro issues that are driving this, so going above and beyond just what we're seeing in the field with claims and risk issues. We estimate the overall US cyber market to be at approximately 3.15 billion. And out of that, we estimate that the top 10 insurers control roughly 80% of that. So what does that do? If there are a handful of insurers that have strategies where they are either restricting coverage or pushing rate, we only need a handful to really shift the marketplace. And we are certainly seeing that. There are some insurers who are reacting in a more volatile type way than others, right? And that's certainly causing some challenges. When you look at combined ratios, it's really no secret that prior to 2019, this was a very profitable line of business for insurers, especially in the corporate segment. We saw a big influx of capacity through the last 4 or 5 years in writing corporate business because it was seen that the organizations that were dealing with cyber related issues or the organizations that were targeted in most cyber attacks historically were larger organizations. So insurers saw it as a good way to diversify their portfolio to write a significant amount of corporate business or middle market business. Unfortunately, ransomware doesn't discriminate by industry and ransomware doesn't discriminate by segment. So many of the more complicated ransomware scenarios are actually happening in the corporate segment. And that's really where we're seeing the most pressure from insurers. Reinsurance rates have continued to increase, and continued scrutiny around coverage has caused a ripple effect in our market. That's no secret. Rapid integration of technology into the modern business model. So this gets back to that point I was making earlier around technology providing significant efficiency, but also creating greater dependency and ultimately greater risk. As that trend continues to develop, we anticipate that we're going to see more cyber and technology issues, and that's impacting the insurance market. The other piece is the idea of ransomware as a service has really, really developed. These threat actors have a business model for ransomware. It's not just a few kids in a basement that are launching these attacks. It's a very streamlined way of launching ransomware. So the sophistication that these threat actors are taking makes it very, very easy for threat actors to launch the types of attacks that they are launching. And then the other thing is the ultimate lack of scale. So, or ultimate lack of scale to withstand a shock event. So I know one of the questions that came in was, what's the overall take-up rate for cyber insurance across the Marsh portfolio? In 2019, that was roughly 42%. That went up to 47% in 2020. So that's across all industries. And what that number means is out of our entire client base, roughly 47% of our clients are purchasing cyber. So that number continues to go up, but there's still a lot of room for growth. And this is a market that continues to evolve and continue to develop. Next slide. So it's not all bad. There are options. And there are ways to approach renewals to still achieve optimal outcomes, right? I would say on pricing in terms, the one thing that I'm telling my clients today is make sure you're prioritizing the coverage parts that really matter to your institution and your organization. Historically, we've been able to recognize the benefits of this notion of cyber as a menu, right? You pick up your cyber policy and it has 8 to 10 different coverage parts. And each and every year, we were able to continue to push the needle on that and continue to seek broader coverage. In today's environment, I challenge clients to look really hard at that and say, what really matters to you? What are you most concerned about? Because if there's a particular part of the policy that insurers are putting pressure on, it's really important to know where those priorities are. And that can help control where the insurers may stand on pricing and ultimately the capacity that they're willing to provide. Certainly, anything that the organization can do to limit frequency and severity around claims is super, super critical. We see particular focus in the market today around how to prevent an impact from ransomware. So looking at critical tools like multi-factor authentication, looking at processes and procedures around backing up data. How frequently is data backed up? Is it air gapped so that malware does not get into the backed up data? What's the process around recovery time and what are those recovery time objectives? Anything associated with getting access to backed up information is going to be a critical focus in today's environment. And then the last thing I would say is on the underwriting side, being prepared to provide a very full and robust submission. Ultimately, the more information that we have, the better results that we're going to be able to achieve. So I thank everybody for the time today on cyber and certainly willing to answer any questions at the end. I think with that, I'll turn it over to Mark.
Great, thanks, Marty. It's good to be back with all you all. So in the exciting world of casualty, we received a lot of great questions that we hope will be answered in the next following slides. Next slide, please. So again, I always start by saying, there's a lot of segments within education. This report is really based on all education. They are different, no doubt. A lot of nuances between a large university, research university, and and a smaller community college. But just want to say that about 85 to 90% of the market and the issues are very similar in all segments. But I do want to say that these do include colleges, universities, public and private, up to the doctoral research institutions, consortia groups that we have, primary and secondary. We'll talk a little bit about those and some of the nuances and maybe some of a little bit of the coverage and rate differences, premium differences we're seeing. And this also includes other educational services for nonprofits, education-related social services, charter schools, vocational schools, as well as technical schools. Next slide. So where did this all begin? Really, the overview is this perfect storm in 2020. It really began starting in really the end of 2016. As you maybe recall, AIG Lexington, backed out by implementing a TBI exclusion, and then CV Star followed to really not want to continue to be in this space. So major players with major capacity began exiting the business, really 2017 and 18. So what's happened really in this past year is, and in the past couple of years, is that rates have been increasing, restricting coverage, and of course, reduced capacity all at the same time, due to really growing frequency and severity at the same time. And then of course, 2020, just about a year ago, everybody was really hit and impacted by COVID-19. And so what's caused that is, of course, conservative underwriting due to unknown claim development. More questions were coming out on renewals, especially on new business. Terms and conditions are really being controlled at the executive level. Because of that severity, everyone's kind of looking over their shoulder and pushing this message down into the underwriting world. So that became a lot more difficult to maneuver within a carrier. And also, of course, diminishing coverage for sexual molestation and abuse and molestation, as well as traumatic brain injury, as we talked before, and also law enforcement due to a lot of civil unrest that we began to see in 2020 that continued throughout 2020. So really that lead umbrella and educators legal is really being hit the hardest. And we'll talk a little bit about that in the next couple of slides. But again, capacity is being cut, and communicable disease really emerged as the main event, main topic by the second quarter, and really continues until today. Next slide, please. So education, higher ed in this particular, again, capacity continues to decrease, and re-underwriting is increasing, both on the insurance and the reinsurance side. We're, of course, always been focusing on carriers that know this coverage, want to provide it, the capacity that they offer, cost, and of course, the service that they can provide in handling the claims and providing risk management services. So the major concern of really growing in this severity applies to all facets of your campus and of the school. Active shooter has become a real big concern across the pond, especially in London, asking a lot of questions about that exposure and what is a school doing about trying to contain that exposure. Athletics, auto, I'm not going to list them all. You see them all, you hear about them all. But we still see really large claims developing from Greek life, any kind of molestation, Title IX claims, law enforcement, and we can go on and on. But I just wanted to list them out a little bit. Of course, wrongful death claims are becoming extremely expensive to handle and to close. Next slide, please. So the outlook really for 2021. Unfortunately, the current trends will continue throughout this year. The question really becomes the insurability of sexual abuse and molestation. Is it insurable? Can we provide it? How can we provide it? Really, reinsurers are struggling with this. The triggers of coverage. Should it remain on occurrence? Should it all go to claims made? What is the benefit of one or over the other? Retro inception dates. So all of that is really being discussed as what is the next step? What is the solution to this? Also schools, of course, are struggling with their campus exposure. Is it online? Is it hybrid? More offline? Time will tell really come this fall as to where that trend is going to continue. I think people are still challenged to try to understand what that next exposure is going to be and what to focus on. But tuition reimbursement, of course, has been a major concern. Class action lawsuits are really testing the quality of online learning and really what the mission of a university is and what additional causes of loss have happened because of that. Med mal carriers are excluding sexual molestation now going forward. So everyone's trying to push off that exposure into other coverage. So all underwriters are very concerned about it because I think they're all going to assume there's going to be more of it. Also, monoline auto. There's been some very large claims in auto activity this past year, 15 passenger vans, just any multiple car accidents, whether it's education or not, that really the monoline auto market is just horrible and very difficult to place. So, we're looking at alternative markets, alternative solutions. We have a market form out there, really pushing the limit. It's always been on an occurrence basis because we've designed a lot of coverage surrounding that. Working right now with many carriers, many syndicates all over the world, trying to determine what the best solution is, what the best option for coverage is, and of course, ultimately, at what price. And we'll talk a little bit about that in the next couple of slides. But always the question has been, what is the cost of the new cost of capacity coming into this marketplace? And it varies dramatically from even a renewing carrier to a new carrier. Next slide, please. So this is one of the most, I think, important slides here because, what is driving this market today and how is it changing going forward? Reviver statutes, are out there expanding the tail coverage and really just changing the tort landscape. People would thought would be beyond claim activity after 7 years or longer. Now that's not the case. And everything's being reopened going back into the 70s and the 80s. And those losses are going to be large. Of course, social inflation, is leading to larger litigation, and the verdicts, are enormous. And a lot of them are headline grabbers, but also they are actually closing out and paying some of the very large 8-figure numbers that we are seeing out there. And third-party litigation funding, is really investing in these types of lawsuits. But this triangle here, is really something I think that's going to be concerning, and really we need to focus on coverage. That's what we want, that's what we demand from our markets to provide our institutions, is the coverage we need, including molestation, TBI, law enforcement. Everything needs to be there because you have that exposure, and it is heavy. So capacity is out there, but not to be confused with coverage, because capacity, yeah, they might be able to put up capacity and limits, maybe even 10 or even 25, but you're not going to get the coverage you need. So that's always the debate of the coverage is the king, how much capacity is out there, ultimately with the coverage, and of course, what is the cost of that? And how do you control those three variables moving all at the same time? Next slide. So we mentioned earlier, United Educators, is really re-underwriting their entire book. Everybody is, but UE is obviously a very major player in this space. So their capacity has also been reduced from 40 million to 30 million on every account. So when you're looking at excess, we'll talk about that in the next couple of slides, is it really being affected the most? There's going to be coverage changes with their sexual abuse and molestation wording. There's a 10-year reporting period with a sunset clause, sublimit of 5 million. We can talk about that a little bit later, how that's going to work. But also a major change is that there's going to be a total policy aggregate on that GLX policy, the lead umbrella policy, which is a big change. It was unaggregated with just SML and TBI being aggregated. Now there's going to be one aggregate, policy aggregate. Pandemic exclusion came out from UE on 1/1, and also it's going to be affecting on all new ELL business as well, because again, severity of claims is a big concern. So there's going to be a new sexual misconduct endorsement that has already been released into the market. And as Marty mentioned earlier, with cyber, UE saying, okay, we've had some coverage in our policy. We want to defer all of that elsewhere. And so I think those policies will have to be scrutinized a lot more. We're still a little concerned with the overreach and with the cyber exclusion with UE. We're talking about that as well. And of course, the expanded telemedicine coverage and endorsement is now available. They cut that back when the pandemic hit, but now with this supplemental application, full policy limits may be available and re-underwritten. But there's a very concerning states for the jurisdictions and litigation in these states, which are listed here are troublesome, and they may deploy their 30, they may not. So that's really an account by account basis. And of course, the pricing is changing all at the same time. Next slide. So another important slide, they all are, but this is probably the second most important, is really the excess liability market and what we're seeing. So, again, the cost of capacity, you can put a number on this, trying to put a number on it, 30, 40, 50. It's hard to tell because the capacity is being cut with the coverage, the pricing is still going up. It's just this unfortunate situation. And other lead carriers are cutting their capacity. They're saying if you want the full coverage, and again, lead underwriters, lead carriers, so out of the gate, we need to make sure that the coverage is available, full coverage with all the ones I've mentioned, but they're saying we're only going to provide 5 million, no longer 10. Actually, just the other day, Genesis actually released a partnership, or not a partnership, but just a lead 10 opportunity with Euclid managers to provide up to 10 million of a reinsurance arrangement. So working again, they're listening to us. They know the need. They want to provide the capacity and really be here for the long term, as all the carriers. They want to be here for the long term to be able to handle these claims and settle these claims years down the road. So they're making these changes now to obviously combat that going forward. But a lot of the excess markets do not want to attach below 50 million. So that's becoming a real challenge, especially with UE and other markets cutting their capacity, creating a major gap in that 25x25 layer. And one thing about, you can read these bullets, but also lookup clauses are appearing on some of these policies saying in quotes, if anybody above us is getting more price per mil, we want more money to try to layer that. So we're very cautiously watching that. And you can see in this graph here that when you look at all the excess limits purchased, this is all as of 7/1, everybody has been buying less and less was available for full coverage again. So this is where sexual molestation, traumatic brain injury, and sometimes law enforcement is now being reduced from full coverage to less capacity for that coverage. Next slide, please. So these again are just exhibits of where coverage was lost. Of course, communicable disease, we never had that exclusion, so people were buying full limits. On 7/1, major cutbacks, all really across the board in every size that we see. Sexual abuse, same thing, still available, again, in the lead layers. Excess layers really became difficult, again, because of the capacity they're putting up, and the chance of that severity hitting them is now just too risky to take for them. And the same thing with traumatic brain injury here at the bottom slide. Again, a lot of limits lost on renewals. Next slide. Educators legal and excess ELL, another shrinking market. Of course, UE is here, 30 million capacity now maximum. A national union, AIG, also cutting their capacity. It's just a lot of claims are out there, just a lot of developing claims. Select counsel is also being revised and scrutinized. The hourly rates are being scrutinized and pushed down on renewals. You have to be really careful and concerned to really getting into the detail of what is being offered on these renewals. Again, looking at individual needs of what is really most important to you and how do we try to negotiate the best terms possible in this changing environment. Next slide. Automobile, I'm not going to go again through these slides, but a lot of scrutiny, a lot of re-underwriting going on, and just monoline auto is a bad risk. And again, we're seeing 8-digit claims being paid on auto. Everybody has vehicles, everyone has 15-passenger vans or buses. That is a real major concern. Looking at student drivers, MVRs are being checked. Just in this renewal marketplace, we're going to have a lot more questions coming from underwriters scrutinizing this exposure very, very carefully. Next slide. Let's move on. Workers' compensation really probably is the only decent market segment, line of coverage that is not exploding. It was a few years ago. It's a little bit more stable now. I think communicable disease endorsements, some of these are still available in the marketplace. Markets are still available to write this business, whether it's excess comp, statutory limits, or guaranteed cost. So that market pretty much is stable. So we can move on to the next slide. Market concerns, again, so these are very serious concerns of us if you're marketing an account, which if you do need it, a new market is going to ask a lot more questions than a renewing market. And even a renewing market is going to be asking a lot of questions. But we're always looking at experience, exposure, what the expiring premiums are, setting the right expectations because so many changes will occur. But we're looking really at what are the options here? What are our solutions? And looking at a variety of things. There's not going to be one solution. It's really all about, risk tolerance. I think every school is different. Every school has different needs or different expectations. So really you have to determine what your risk tolerance is. Because whether it's a quota share, corridor retentions, we can talk about captives, excess captives, filling in a certain higher rate or higher limit. that you need, that I think is probably going to be where the greatest need will be. Alternative risk solutions are definitely, in the know and being discussed a lot. Reinsurance memorandums. There's going to be a lot of just alternative programs that we can structure, whether they're integrated programs or structured programs. A lot of different ways that we can approach the exposures that exist, and whether they're through reinsurance memorandums, like I just mentioned about Genesis and Euclid and their arrangement, but also for sexual molestation, there may be more of a per claimant retention, which we're trying to figure out what is an underwriter's capability going to be to attain and retain that exposure to provide some coverage. Again, whether it's occurrence or claims made, but trying to find a way to provide the cover. First loss triggers, aggregate stop loss, there's just a lot more options that are out there, really ultimately to give you more control of the destiny of your insurance program. Next slide, please. I'm not going to get into these. Obviously, we talked about molestation and auto, but there's so much else going on campus, from daycare centers and again, from construction risks and protests on campus and other things in health clinics that exist, healthcare, vaccinations that are going on right now for COVID. So we've seen it all, even though the good news is right now, sporting events, a lot of the large exposure on campus has been reduced. Other exposures have been increased. Next slide, please. So talking about, market guidance and really exposure and where our premium's going, it's very difficult to predict, honestly, where we are. The numbers are going to be probably in the double digits. Honestly, in the lead and then on the primary side, again, because they're only putting up $1 million. So that may be contained with like a 10% rate increase possibly, or 20. But I think in the lead umbrella and excess umbrella, we are seeing some sizable increases. And they could be much higher than 40 and 50% of what we predicted earlier, because we're seeing those. Really both in liability, GL, educators, legal, and of course the lead and the excess umbrella. Not so much in workers' comp, not so much in the internships and professional liability, but unfortunately in most other lines, there's going to be some tremendous challenges. Next slide, please. And this is the primary and secondary education, like I said, a little bit different. It's still erratic. There's no doubt about it. It really depends on jurisdiction, a lot of it. But I think also the use of captives, alternative risk solutions, retained limits, those are all options that unfortunately we will need to entertain, look at, and trying to see what kind of programs is going to be best structured for the K through 12 industry, independent schools, and public schools. Again, capacity is available, but again, a lot of re-underwriting is going to continue. Budget restrictions, we know there's reduction in staff, very concerning, and the results are going to be varied all over the place. But, of course, overall poor underwriting experience, is creating and fueling the volatility in this. Next slide, please. And I will conclude really with, again, the rate guidance with them as well. Probably not as bad as higher ed, but I think there's some challenges here, again, with school board legal and other areas of risk where we have seen pretty intense loss of volatility in that area. So with this, I will turn this over to property and David.
Thank you, Mark. Appreciate it. And thank you, everybody, for joining us. I think, property probably is the line of coverage that led sort of the market changes. So I think we were out a little bit in front of casualty and the financial lines products, but maybe hopefully at the end of this, we can leave with a little bit of a glimmer of hope from property as opposed to maybe what we're hearing from some of the other lines. So if we can go to the first slide, what we see here, is kind of general big picture themes. Property insurance market, our client list last year through 2020 saw rate increases as very much a standard happening. And in Q4, what we experienced was that 81% of our client renewals experienced a rate increase. That was a continuation of a pattern that has gone on now for 13 consecutive quarters, going all the way back to Q4 of 2017. Some of the things that we're seeing, from the market standpoint, underwriters, what they're pushing on is not only rate, but also terms and conditions. And we think that will continue this year in particular on the terms and conditions side of things. So one of the things, as Mark also talked about as well, communicable disease, seeing exclusions for communicable disease, where previously we've been able to build in some degrees of coverage for that in many cases. I would say now there are, any market that is offering the coverage, such as FM Global, what they are doing effectively is they're providing an exclusion via a very small sublimit. So they'll give you, I think, maybe $10,000, maybe as a maximum for communicable disease. And we're also seeing pushes from underwriters on coverages like cyber coverage, pushing for exclusions, where again previously we've been successful in sort of adding that coverage in. Sort of a new one is strikes, riots, and civil commotion, and that is really driven by not only what occurred this past year, this past summer with the protests that went on, but also two protests that went on in other parts of the world as well. So, for example, there was in Chile, there were some very significant losses associated with strikes, riots, and civil commotion type coverage. Another one that some of the other ones that are being pushed, for example, in terms of terms and conditions, civil and military authority, I think that largely ties back to COVID and what we saw there, and things such as service interruption and contingent business interruption as well. And then for clients, for insureds that have had losses on their programs, and in some cases even those that have not, certainly a push for deductible increases. And there's probably a degree of logic to that. If you think in terms of, I know we have many insureds, many clients where the deductibles have remained relatively static for the last 10 or 20 years. And you kind of correlate that with, sort of the inflation factor that would have occurred with loss costs and repair costs during that time. There is probably an argument to be made there as to the appropriateness of those deductible increases. On the next slide, what we'll see is our Q4 2020 results kind of broken down into different categories or different buckets. So the bar chart, what you see are starting from the left-hand side, those insureds, those clients that had rate increases over 20% in the dark red, and then moving all the way across into the yellow, which is where there was no change, and then all the way to the far right-hand side, where there was actually reductions. So on top of that, we've overlaid a trend line that you can see, and then also another trend line in gray, which is the 2019 full year. And so what you can see is that in 2020, there was a kind of a greater pace to the rate increases than what we saw in 2019. So 2019 was a year full of rate increases as well, but maybe the pace of those or the curve on those that wasn't quite as great. They weren't quite as steep. Interestingly, here we also have 10% of our clients or insureds saw rate reductions, and why would that be? And I think largely that's around either situations where they bought less coverage, or they retained more, they took a larger deductible, and in some cases they self-insured part of their program as well. The average rate change in 2020 Q4 was 19.9%. But when we talk in terms of averages, there's a lot there to consider. We like to say that there's really no average result. There's a very wide range of outcomes that occur within that, and for a whole lot of different reasons, whether it's occupancy or loss history or risk quality or whatever. Or maybe somebody's coming off of a 2 or 3 year deal that they had in place. So there's a host of reasons why those rate changes were what they were. And so I just caution, when we talk about averages, it's truly that, it's an average. On the next slide, just sort of a continuation of that same story, or just some more information behind it. This is showing our rate changes, again, kind of in buckets, all the way going back to Q4 2017 through Q4 of 2020. So 3 years worth of data. And if you were to draw a line, a trend line, what you would see is, obviously a trend line that is diminishing when it comes to rate reductions, which are in green, and accelerating when it comes to rate increases, which are shown in red. On the next slide, what we're showing here are global insured losses. So these are the top 10 largest insured catastrophe loss years. And what we're talking about here are global insured losses. So this is not just the US. In property, things that happen outside of the US often affect US insureds as well. About 50% of the insurance industry's property premiums come from the US, but about 50% of them come from outside of the US as well. And so the losses, and it truly is a global community. So the losses that occur elsewhere sometimes can have an effect, or a ripple effect, on us here in the US. One of the things that we're showing here is that 2020 is a record year, but I would caution that with it might be a record year. And that's really dependent upon the COVID outcomes. Again, when we're talking about COVID results, and you see those kind of at the top end of that bar for 2020 in yellow, when we talk about the COVID losses, there's two different aspects to this. Number one, there's sort of a low end range and a high end range, and we'll talk more about that in a moment. But also too, obviously, I think everyone's aware, we've not really seen many COVID claim payments, in the US. In fact, I'm not aware of any from the property side. But that's not to suggest that there aren't insurance companies that have reserves on those losses potentially. But also too, because we're talking about global losses here, you have to remember too that, with COVID, it's a global event, and there are different jurisdictions where, the treatment might end up being different than perhaps what we're seeing in the US. And we saw a recent court ruling in the UK, for example, that might suggest that it might be a bit different of an outcome there in certain circumstances. So, and more to follow on COVID in a moment, but just bear that in mind too when you're looking at these losses. I've had questions, as to, I'm not aware of any COVID property losses. Why is this on here? And that's really the reason why, is because there are some reserves, and there are different jurisdictions involved. Another thing that's interesting here is that you'll notice 3 of the top 5 loss years, or catastrophe loss years, have occurred within the past 4 years, since 2017. So we have 2020, 2017, 2018, all being top 5 years for catastrophe losses. And then also too, in 2020, one of the things, and it was touched upon earlier by Paul, but one of the things that we saw in 2020 that was a bit unique, a bit different, was the magnitude of severe convective storm losses. And so those are losses that are tornadoes and derechos and hailstorms, for example, are all part of the severe convective storm losses that occur in the industry. And last year, first time I can recall ever, the severe convective storm was actually the leader for catastrophe losses. I think it made up something like 40% of all the catastrophe losses that occurred. And that's a continuation though as well, albeit a larger proportion, but we've seen 13 straight years where severe convective storm losses have exceeded $10 billion. And then on this next slide, we'll talk about the top 10 largest insured events. And so here again, what we're seeing is the COVID losses. And so this is kind of taking COVID in a range, a low end range and a high end range based on what markets have reported publicly. And so that's how we're capturing this data. And I think one of the important things to remember here is that the COVID losses being reported are not, in fact, probably in large part are not property damage and business interruption. But in fact, in large part, the driver for the COVID losses is actually in what's known as the contingent market. And that's things such as event cancellation. So, maybe there was a concert scheduled with tickets sold, and then that concert had to be canceled because of COVID. And as a consequence, there was a very significant financial loss. So that's really, I think, in large part the driver of the COVID-19 losses. But again, it does affect the overall capacity and stability of the marketplace. Another thing that we notice here is that 4 of the top 10 catastrophe losses or events have occurred since 2017. So COVID in 2020, and then also hurricanes Harvey, Irma, and Maria, or the HIM events, all of which occurred in 2017. We also did receive a question, have been receiving questions about Winter Storm Uri and its impact. And I think, it's a little bit early to say on that, but at least one publication that I saw did suggest that their modeling, indicates that Uri may actually be a larger event than Hurricane Harvey was. So if that holds true, or if that's correct, then that would put Uri in a top 10 position as well. Moving on to the next slide, we'll start talking a bit about our PlaceMap benchmarking site, where we collect all of the information on our renewals and aggregate the data. And so here we're showing the average and median outcomes for each of the quarters in 2020. The average results are shaded in dark, and the median results are shaded in light. And what we see here is, and this is sort of my point earlier in talking about averages and being cautious about them. What we see here is a pretty meaningful delta between the average and the median results. And I think what this really shows, if you look at the medians, they're relatively constant, ranging from 13% to 17%, 17.5%. But the averages have a little bit more fluctuation to them. And I think what that's demonstrating, particularly the difference between the medians and the average, how far apart they are, I think what it's demonstrating is the impact of outlier events or outlier results on the averages. So, bear in mind when you hear us talk about averages or anybody else talk about averages, they can have a pretty meaningful impact. And then also too, this is not just education specific. This is actually from all industries. So this is education, manufacturing, real estate, retail, chemical, all sorts of different industries. And we'll talk more about education specific in a moment. And then on this next slide, what we see is sort of, again, a breakdown of the results in different components. So CAT exposed and non-CAT exposed programs. Typically, we think of a CAT exposed program as being something that has perhaps 20% or more of the insured values in natural catastrophe exposed areas. So flooding, earthquakes, hurricane areas. And then the next set of columns or bars is large programs and small programs. And then at the very bottom, showing kind of month by month as opposed to quarter by quarter results. I think here, probably one of the most interesting aspect of this chart is that the divergence that you see between large programs and small programs. And that's something that we experienced quite a bit last year, or that we've noticed really on through since 2018, 2019. And it's really a function of the ability to create competition, with the smaller programs, which are those programs that are less than $1 million in premium and single company programs. There's just more ability because we're dealing with one company to create competition. Whereas with the larger programs, you're typically relying on multiple insurers. On the next slide, what we see here, kind of most interesting, we see that, in the Q3 and Q4 last year, about 20% of our clients reduced limits in each of those quarters. And about 15 to 18% increased their deductibles during that time. But what also is interesting to me in particular is that about 20% increased their limits, which kind of runs counter to the idea of rate increases and everything else. But I think the reason for that is probably a positive note. It's probably that they were buying coverage that previously they had a little bit more challenge doing because the capacity was coming in at prices that were favorable enough to them to warrant them buying the limits. On the next slide, we are seeing kind of historical underwriting performance based on combined ratio, or is calculated by combined ratios for the property casualty marketplace. And here, interesting, in the red bars, you see years in which the combined ratio was over 100%. So insurers didn't make any profit on the underwriting side. And then in the gold, what you see is a rolling 10-year average combined ratio. And you see that right now at present, it's at the highest rate that it's been at 97%, highest rate it's been since 2005, 2006. The other thing you'll notice too is that when you see the red bars, you notice that the blue line, which is our average rate changes, you'll notice how that jumps up as well. So there's a very strong correlation there. On the next slide, we get into some more specific education related information. So here we're showing some of our benchmarking data for education clients with insured values greater than $1 billion. So we'll talk here about large clients, if you will. And what we see is, median results in terms of rate, 3.8 cent rate as an average. And looking at the bottom chart, a line chart, focusing in on Q3, because that's really when most of the results would have been captured, a 24% rate increase on average for those large clients. On the next slide, we'll talk about smaller programs. So those clients with insured values less than $1 billion. And here, what we see is that the median rate jumps up to 8.3, almost 8.4 cents. And typical results in Q3 were about 12.6% rate increase, so a little bit better than what we saw previously. On the next slide, just talking in terms of, what are some of the drivers of your rate change. We talk about it, it's very specific, very nuanced. But the things I want to focus on here really are, as drivers currently, risk quality and loss control focus are huge. That is something that many markets are very focused on at the moment. So you need to have a very good loss control story when you're talking to the markets. And then also deductibles being set appropriately. And on the next slide, we've already talked about severe convective storm as being sort of a new driver, if you will. And then some of these other things that we talked about that insurers are starting to sort of cut back on in terms of contingent BI and strikes rights and civil commotion, but really some new emerging loss drivers that are focus points for underwriters. And then we can start talking in terms of some of the hot buttons. We've talked about some of them already, but on the next slide, what we see is Company forms, there's a push now from insurers to write on their own form as opposed to writing on manuscript forms. And also too, a push for a heavy focus on valuations and deductibles as well. A lot of situations where insurers have been surprised by the losses that they incurred because of the fact that the valuations that were reported ended up being a lot different than the loss amount that actually ended up settling out at on a specific loss. So next slide, we'll talk about, kind of future expectations. I think from this perspective, looking at the market cycle there, I would suggest we're probably in the sort of upper left-hand corner there in terms of where we're at with the property market. There are some challenges still. For example, bond market returns, long-term bond yields are down 84% since the year 2000. And that really, what that means is that there's going to continue to be more of a focus on underwriting profitability as opposed to trying to make the money on the investment side. However, that said, we are seeing glimmers of hope where technical rates seem to be coming into line and maybe at a point now where underwriters are comfortable with them. And we've certainly seen some behavior in the first quarter and maybe even late last quarter that would suggest that there might be a bit of a change in there. And that's going to be, again, very specific and nuanced to each different situation. But generally speaking, a lot of talk from markets about wanting to grow. And I think that, the fact that the rates are maybe getting to a point where they're comfortable, we're going to start to see, a tapering of the rate increases, for many situations, but not for all. Lastly, in terms of recommendations on the next slide, I think here the biggest things are really, just reviewing the coverage that you have and making sure that you review kind of the nice to haves versus the necessary items that you need for cost savings opportunities. And also too, we have an awful lot of clients that are looking at alternative risk solutions. Mark touched upon structured solutions and integrated programs as examples, but another one that's big right now are parametric solutions, which have a different coverage trigger than you're accustomed to, with property damage being the trigger for property policies. With a parametric, it's a different coverage trigger. It's usually based on some event either happening or not happening, or some index being exceeded. It's useful for things like severe convective storm, earthquakes, flood, and even things such as snow removal as an example, to balance your budget on snow removal. And one of the great things about parametrics are the speed and the simplicity of the payment. So either the event happens or it doesn't, and if the event happens, you get paid. That said, one of the things that we're not seeing is clients buying parametric products based simply because of the price being so good, because the pricing really can be pretty expensive. And then one last slide, and then we'll turn it over. These are some of the key markets for higher education property. But want to also focus on or highlight, we've got new capacity coming into the market. There's Alcor in Bermuda. There's a startup in London called Inigo, which is being run from the property side by a guy named George Stratz, who used to work at AIG. Very well capitalized. They started up with 800 million. Mark had talked previously about Convex and Stephen Catlin. And then there's Fidelis. Both of those have over $1 billion of capital behind them. There's another market in London called Key, which is kind of revolutionary. It's algorithm-based underwriting, and that's really the sole focus. So lots of new capacity coming in that probably can only help, but have a positive effect. One last thing is, Winter Storm Uri and what effect it will have. I suspect that will be more localized and regional, although it probably does have an impact on public entity and higher education as well. So With that said, I'm going to stop here and turn it over to Ken to talk about health and benefits.
Hello, everyone, and I see we're running short on time, so I'm going to run through this quick because I want to get to Jeff Smith's student health piece. So we spent most of 2020 focused on gathering data for our clients as it relates to the pandemic. I'm only going to go through the highlights from our fourth survey, which was conducted in November and results released late November 2020. If you would like a copy of the full report or any of our reports, let us know and we'll be happy to get you a copy. You can proceed, please. So key findings. First, we found 49% of institutions hit or came close to their target enrollments, which we thought wasn't too bad given the situation last year. However, 84% missed their budget targets, and that's likely due to the costs from COVID-19, as well as a loss of revenue streams for tuition, room and board, fees, et cetera, athletics, et cetera. Institutions have addressed the budget deficits a number of ways, one of which is staff layoffs. Some of you may have seen that already. And another way that we're commonly seeing institutions dealing with budget challenges is not providing merit increases for base pay for the upcoming year. And a full 62% responded that they were not providing a merit increase, with another 29% still deciding. I suspect that number has grown since November, and it's probably a full 85% have not provided a merit increase for this year. Flexible benefit or flexible work arrangements, as you know, in the higher ed world, that's uncommon. Many of you had to adjust for that for the pandemic. We find that 46% of institutions are likely going to continue the flexible work arrangement schedule, which is really unheard of in the higher ed space and is going to create a number of changes in terms of how you manage your employee populations. If we can flip ahead, please. Working remotely, however, has been quite successful, and I'm going to show, actually, I'll probably show a slide a little bit later. 90% report a positive or no impact on employee productivity, which is really great news for those of you who like flexible work arrangements. 75% a positive impact, positive or no impact on work-life balance, and 76 report a positive impact or no change to communication and collaboration. So those are all signs that point to the fact that remote working will continue. There is one downside to remote working, in that we're finding that mental health or behavioral health tends to be a challenge on campus, not just for faculty and staff, but for students as well. 54% report a negative impact. This was a surprise to us. So despite the fact that budgets have been challenged, we really thought that the health and the benefits aspect for faculties and staff would be impacted greatly. We found that 93% of institutions have made little or no changes to their health and welfare plans in 2020. Whether that continues or not, it's to be determined. Can we move forward, please? Back to this flexible work arrangement. So again, 46% have indicated that they're going to move forward with that. 97% of that 46% indicate that they're looking to do this on a full-time basis. So again, good news for people who like the flexible work and like to work from home. Move forward, please. Back to this remote working. I talked a little bit about this already. These are the positive impact of remote working that higher ed saw in 2020. Some of these statistics I've already mentioned. Again, mental health was really the only area that was negative, and we'll see some. There was a question came up, and I'll address that a little bit later in the presentation. Move forward, please. So voluntary separation. So this has been trending upward for the last 5 to 10 years. We're seeing a significant uptick in this again. One of the ways to manage budget deficits is to offer separation of employment. And we're seeing a significant uptick in terms of early retirements or some type of package being offered to both faculty and staff going forward. Move ahead, please. And then we talked about the merit increases. 62% of institutions were holding pay as is. Another 29% were thinking about it. We think those numbers have increased. I'll move quickly. Move ahead, please. And then lastly, the benefit strategies. So the question that came in is, so what do we see for 2021 and 2022 beyond? So again, you're going to see policies come out on remote working, which again, good for people who like to do that. We're going to see a focus on behavioral health, and that's really around access to care, access to counselors. So you're going to see an uptick in telemedicine approaches to behavioral health, if your institution hasn't done that already. And then lastly, there's going to be a focus, we think, on elder care and child care. That might be part of your rewards mix going forward. Many institutions are talking about that now, and likely will have implement changes to that in 2021 and into 2022. That was quick. I'm going to turn it over to Jeff to talk a little bit about student health insurance. Jeff, you may be on mute.
Sorry about that. If we can advance the slide, please. So in terms of the student health landscape, and I'm really primarily talking about student health insurance, some things have remained the same. The markets there's relatively few carriers, they're relatively inefficient. And because there's little competition or relatively little competition, we see conservative to very conservative rating factors, including trend, administration, pooling charges, and things like that. Because of that, we're seeing on the kind of the other corner, an 8% increase in rates projected for 2021 and 2022. And when I'm talking 2021, 2022, I'm really talking about the academic plan year. So what we're seeing is relatively few carriers. It's the same carriers that have been in place for a few years, seeing higher than average increases. But at the same time, what we're also seeing, and this was one of the questions that came up in advance of our call today, is that there's concern about COVID and what impact does COVID have on student health? And there's really probably three primary areas. One is that the insurers are being very conservative with COVID. So what we saw, like we saw on the employer side, we saw big dips in spring of 2020, really throughout, on and off throughout 2020, as there were lockdowns in terms of people being able to seek care, or at least people were too concerned to seek care. So what we saw was that costs were down, but the carriers are by and large saying, that was a fluke, it's going to come back plus. So that's one thing. The other part of that is we also saw a decline in international students, and that's not only due to COVID, but also due to prior administration, at the national level. So what we saw was international students kind of opting out of the plan, or being given the opportunity to opt out of the plan more easily. And as we know, international students tend to subsidize the domestic students. So that also created an increase in overall costs. But what we are seeing is because of the rising unemployment, and that's with, perhaps students returning, or I'm sorry, employees returning to school to continue education. What we're seeing is, parents losing jobs, partners losing jobs. We are seeing increased demand for the student health insurance plans. And that's actually a very positive thing. And we want to make sure that you're taking advantage of that. And as Ken mentioned, the one in the middle is really increasing demand for limited supply of behavioral health. So Adam, if we could advance the slide, please. So I'll talk about a few of these, and then I've got actually some subsequent slides. But really, one of the things is, how do we leverage total population of your institution? Think not only about the students, but think about employees. And if you have the employee plan with, let's just say, Aetna or United Healthcare or whoever that might be, is there the ability to leverage that total size of both the employee and the students across both populations? The next one down is student assistance plans. Think of student assistance plans as an employee assistance plan, but for students. It's very inexpensive. It's a way to supplement perhaps your CAPS programs, counseling and psychological services programs, with a telephonic, multimodal approach for people to seek care when they need it in times of stress and or need. So that's another area where student assistance plans are really kind of coming into their own. And then I think the last thing on this slide is really student health. think of it as, as you're thinking about employee health in terms of vaccination, COVID vaccinations, COVID testing, as you're thinking about ways to approach your population, make sure that we're including both the student and the employee base so that we're really maximizing efficiency and being able to leverage the population. One other comment I'll say about COVID, and I'm just trying to be cognizant of time, is that we've not seen dramatic changes in plan design or provisions. Really, those plans kind of continue to operate as they have been, but we are seeing, once again, some institutions thinking about, oh, do we run COVID vaccinations through the student health insurance plan, or do we run it through like the university on like more of a ledger basis, or perhaps even out of general assets? So a couple of different strategies there that we could certainly talk to you more about. But the last thing on this slide is really self-funding. And Adam, if you just advance to the next slide, that would be great. So really, as we think, self-funding for student health insurance plans is pretty rare. There's like 30 to 50 organizations across the country, but it's becoming more prevalent and more universities are talking about it, because you self-fund student health insurance plans for the same reasons you self-fund your employee plan, right? Take some of the risk and profit off the carrier, absorb the risk, especially when you have larger pools of population where you can kind of account for the ups and downs. Generally speaking, it's going to be a cost savings for the students and the university. And then at the same time, you can then pick the best of the best. So maybe you want medical network ABC, but instead of using their integrated PBM solution, perhaps we want to go to an ESI or a CVS or somebody else that might be able to drive better value and less disruption in terms of formulary and things like that. I think at the end of the day, generally speaking, as we look at self-funding for some of our larger clients, typically we're seeing savings of up to 10%. So think about not only the students saving money, but also with many institutions that are funding some of the student health insurance premiums, maybe 25 to 35, maybe even 40%. That becomes savings to the university as well. If we just go to the next slide, Adam, this is really what I was talking about before. This is just a case study, but this is where we brought together both the employee plan and the student health plan. Not that we integrated plans, but we integrated with one vendor, and then we were able to get better savings on the student health side because we had a whole bunch of students and a whole bunch of employees that we could leverage and bring together for economies of scale. But at the same time, on the ASO fees on the employer plan, we were able to say, let's look at that total population for downscaling of ASO fees. When I say ASO, excuse me, I mean self-funding administrative costs. So once again, in this case, 11%, but I would not be surprised to see anywhere from 5 to 10 kind of all day. So with that said, that's it for me. I apologize for moving very quickly, but Jean, I'll turn it back to you.
Okay, thank you so much. We have embedded a lot of your questions, so we'll move on from this slide. Thank you, folks, for staying with us today. We still have an excellent number of participants that are able to maintain, listening to our message. So thank you, Ken. Thank you, Jeff, for your understanding and for moving through quickly, but really, really good information. We're interested in your opinion. We will circulate a replay and a copy of the slides for you to have. If you want a copy of Mercer's full report on their survey results, please let us know. And please remember to take our survey when you receive the follow-up email. So next slide. On behalf of our panelists, thank you so much for listening in today. We hope this was helpful, and we may have another interim market update in the coming months. Thank you and be safe.